Over 17,000 SmileDirectClub customers signed the same agreement. The condition was identical every time. Accept the refund and never tell anyone what went wrong. The company that wrote those agreements had a valuation of nearly $9 billion and Smile Shop locations inside CVS pharmacies across the country. When a court ordered every one of those customers released from what they had signed, SmileDirectClub had 3 months left before it ceased to exist. The lifetime guarantee it had sold to millions of customers would not survive the company that made it. But this story does not start with a condition attached to a refund. It starts with a problem worth solving and a promise that millions of people believed. In 2014, two childhood friends from the Detroit suburbs founded SmileDirectClub around an observation that was difficult to argue with. Traditional orthodontic treatment in America cost anywhere from $3,000 to $8,000, required years of recurring in-person appointments, and remained out of reach for the working-class and middle-class families who needed it most. They were people who had spent years avoiding a smile in photographs because they could not afford to fix what bothered them. Alex Fenkel and Jordan Katzman believed they had an answer. The model was direct. A customer would either receive an impression kit in the mail to make a putty mold of their teeth at home, or visit one of the company's Smile Shop locations for a 3-dimensional digital scan. A licensed dentist or orthodontist would review the treatment plan remotely. Then a series of custom clear plastic aligners would arrive by mail, bypassing the clinic entirely. It was faster than traditional braces, significantly cheaper, and accessible to people who had spent their whole lives avoiding orthodontists because of what it cost. Private investors believed it. In October 2018, a funding round led by Clayton, Dubilier and Rice valued the company at $3.2 billion. The following April, a partnership with CVS Health announced Smile Shop locations inside hundreds of CVS pharmacies across the country, placing dental consultations next to the pharmacy counter. By the summer of 2019, SmileDirectClub was preparing an IPO targeting over $1 billion raised at an $8.9 billion valuation. What nobody was asking, in the middle of all that momentum, was what happened to the customers for whom it did not work. On September 12, 2019, the stock began trading on NASDAQ at $23 per share. Before the opening bell, the company was described as one investor should love. By the closing bell, shares sat at $16.67. In a single trading session, the stock shed nearly 28% of its value. It was the worst first-day performance for a billion-dollar IPO in a generation. The analysts who had called it a company to love would not call it that again. What the public markets recognized on day one, private investors had chosen to look past for months. This was not a software company. It was a medical device company with massive customer acquisition costs, operating in a space where regulators and established practitioners were already paying close attention. The regulatory walls were already forming. The stock found a temporary floor after the initial public offering. It would not hold. The California Dental Board had raided Smile Shop locations in Oakland, San Francisco, and Hollywood back in May 2018. SmileDirectClub called it harassment and filed a federal antitrust lawsuit against the board in October 2019. But that same month, California Governor Gavin Newsom signed Assembly Bill 1519 into law, requiring dentists providing teledentistry services to review patient x-rays before moving teeth. The bill struck directly at the company's core value proposition. Speed and accessibility through removing in-person clinical oversight had been made legally complicated in the country's largest state. In November 2019, the California Attorney General's office filed a 24-page formal disciplinary complaint against SmileDirectClub's chief clinical officer, citing gross negligence and aiding the unlicensed practice of dentistry. When Reuters reported the story in February 2020, the stock fell 8 to 10% in a single session, and the regulators were not the only ones watching. Align Technology, the maker of Invisalign, had been both an investor and supplier to SmileDirectClub before becoming its most aggressive competitor. After SmileDirectClub rejected Align's acquisition offer, Align opened copycat scan shops using confidential information from the partnership. SmileDirectClub won an arbitration in early 2019, ordering those locations closed. But in March 2021, a separate proceeding ordered SmileDirectClub to pay Align $99.7 million for the redeemed value of Align's original ownership stake. A further $63 million judgment followed in May 2023, directly hitting the company's remaining liquidity. By early 2020, the stock sat near historic lows. The regulatory landscape in California had been permanently rewritten, and legal costs were draining what little liquidity remained. The regulatory battles were real, the arbitration losses were real, but neither of those is what actually destroyed SmileDirectClub. What broke this company was something the company had built itself and spent years making sure no one could talk about. On January 21, 2020, the New York Times published an investigation into how SmileDirectClub handled its dissatisfied customers. The reporting documented cases where treatment had failed, some leaving patients with new dental problems. Several of those customers had been offered refunds. Every refund came with a condition. To receive their money back, customers were required to sign a non-disclosure agreement. The agreement prohibited them from telling anyone about the refund. It required them to delete negative reviews they had already posted online. It required them to withdraw complaints they had already filed with the Better Business Bureau. And it required them to notify SmileDirectClub directly if they were ever subpoenaed, giving the company the opportunity to seek a court order before those customers could say anything in a legal proceeding. The Times story described a handful of cases. The full scale was different. The District of Columbia Attorney General's office sued SmileDirectClub in December 2022. The investigation determined that over 17,000 customers across the country had signed these agreements since 2016. 17,000 people who had complaints, who had been paid in exchange for their silence, and who were contractually barred from ever going public. The financial penalty built into each agreement for breaking it was $10,000 per violation, and if the non-disclosure agreements were the only mechanism, SmileDirectClub might have contained the damage longer. But the company had also embedded mandatory arbitration clauses into its terms of service, blocking customers from filing class action lawsuits and routing individual complaints into private proceedings with no public record. When NBC Nightly News broadcast its own investigation in February 2020, featuring customers reporting pain, bite problems, and worsening dental conditions, SmileDirectClub did not respond with a product review. On May 18, 2020, the company filed a 205-page lawsuit against NBC Universal seeking $2.85 billion in damages. The suit alleged the broadcast contained more than 40 false or misleading statements. If you are wondering how that is even legal, so is everyone else. It was the same story 17,000 customers had already been paid and were legally bound not to tell. The lawsuit was dismissed in December 2021 under Tennessee's anti-SLAPP statute, a law specifically designed to prevent corporations from weaponizing litigation against journalism. SmileDirectClub appealed. The Tennessee Court of Appeals affirmed the dismissal in September 2024. The D.C. Attorney General settlement came in June 2023. SmileDirectClub was required to release all 17,000 customers from their non-disclosure agreements nationwide, to contact every former signer and inform them they were free to speak and to pay a $500,000 penalty. The company was prohibited from using the practice going forward. 3 months later, the company filed for bankruptcy. On September 29, 2023, SmileDirectClub filed for Chapter 11 protection in the Southern District of Texas. The company reported assets between $500 million and $1 billion against liabilities between $1 billion and $10 billion. The founders committed $20 million in debtor-in-possession financing. The plan was to restructure, find a buyer, and continue operating in some form. No buyer came forward. On December 8, 2023, 17 days before Christmas, the company announced it was ceasing all operations immediately and converting to liquidation. Approximately 24,000 customers were still mid-treatment, still making monthly payments, and had no one left to call. The company's homepage was replaced by a single FAQ page. The lifetime guarantee was no longer honored. Aligner shipments stopped without notice. Monthly payments to Healthcare Finance Direct, the third-party financing company holding customer installment contracts, were still expected in full. New York Attorney General Letitia James issued a cease and desist within days, ordering the company to stop telling customers they were still obligated to pay. In December 2024, her office announced a $4.8 million compensation plan covering more than 28,000 affected consumers. On January 26, 2024, the Chapter 11 converted to Chapter 7 liquidation. SmileDirectClub was gone. SmileDirectClub did not collapse because regulators caught up with it. It collapsed because the machine it had built to survive could not hold simultaneously against 17,000 released customers, a dismissed billion-dollar lawsuit, a state attorney general enforcement action, and a liquidity crisis driven by its own legal losses. The machine failed on every front at once, and there was nothing underneath it. The lifetime guarantee was never backed by anything that could outlast the company's ability to suppress the evidence that it was not working. When that ability was removed, SmileDirectClub had 3 months left. If you have watched this far, you already know this pattern does not belong to one company. The next story is about a $12.5 billion Canadian institution that built the same kind of trust and spent it differently. It is worth watching before you assume the brand you trust today is the same one it was 5 years ago.